The European markets are seeing a good boost after the central bank offered to provide cheap loans worth 530 billion euros for a period of 3 years to the banks in the region. Markets were hoping that this money would help the banks in the region to lend more, boosting the economic recovery. In December last year, the ECB extended cheap loans worth 489 billion euros to the European banks, and the larger than expected takeout loans will boost the flow of funds into riskier assets, giving the markets in the region a big boost. The euro also continues to rally against the dollar, but analysts believe that the gains will be short-lived. Let's get in a detailed global perspective on the same news. We've got Sarah Hewen, who is the head of research at Standard Chartered, who now joins in on the phone line. Sarah, thanks very much for joining in on the show. What do you make of this amount of 530 in terms of the LTRO? Would you believe that it is on expected lines and perhaps already been priced into the European markets?
Well, it was pretty much in line with expectations. It was slightly larger than the first LTRO, first 3-year LTRO, which took place late in December. And this comes pretty much in the midpoint of what the range of expectations had been. Obviously, combined, these two long-term operations deliver a 1 trillion euro boost to liquidity, which is very significant. We've seen the impact of the last LTRO already in terms of reducing money market rates and also helping to lower borrowing costs for countries like Spain and Italy. So the chances are that this latest LTRO will also deliver some positive benefits.
Sure, Sarah, there's so many views floating around regarding this number. You have a lot of analysts who are saying that this LTRO is merely buying time rather than actually solving the Eurozone debt crisis. And they're also warning of excess liquidity that could weigh on the currency over the coming months. Would you subscribe to this view at all?
I think when we're talking about the currency, we need to look at what the other concerns are. We are going through a Greek debt restructuring at the moment, but there are still worries about the political situation in Greece and what that might bring. We have other countries, Ireland and Portugal, who are going through the bailout process as well. So we're certainly not out of the woods in terms of the sort of underlying risks in the euro area. I mean, in terms of the liquidity impact on the currency, that's certainly something to bear in mind. The liquidity impact on the real economy ultimately should be positive, and that's something which is very significant for Europe, given the credit crunch conditions that we have currently.
Also, Sarah, if we focus on the equation between the euro as well as the dollar, it's been fairly volatile of late. As we speak, it's 1.34. What kind of trajectory are you anticipating for the euro versus the dollar? And do you believe that the movement that we're seeing right now is purely just a knee-jerk reaction?
We think that this strength is unlikely to persist. There is something of a sort of knee-jerk reaction to this amount, obviously, but the concerns that we have do relate to the underlying fundamental problems in the economy. Euro area, we think, is going to be in recession. We've already seen one negative quarter. We think that we could well see further weakness in the coming months and the coming quarters. So these factors are likely to weigh on the euro as well. And we think that, a big liquidity injection ultimately is something of a headwind against the euro over the longer term.